Hey guys, this is the second in a series of 10 videos specifically addressed for beginners on how to get involved in savings or investing. If you haven't seen it, I would suggest going back to our first video to get a gist of what this is all about. In this video, I'm going to talk about the types of investments that you could consider to take advantage of any trading environment or any economic environment. And you could look at stocks, bonds, mutual funds, or things called ETFs. ETFs are called exchange traded funds. I'll get into a little bit more about each one of these categories. You could also trade currencies. You could trade commodities as a hedge against inflation. So there are many different investment vehicles to participate in to take advantage of markets that are going up. And there are also vehicles to take advantage of markets that are going lower. Right now, we are in a market environment where the Federal Reserve is actively raising interest rates, and so this is generally considered a headwind, something that is a challenge to stock and bond investors. But you can take advantage of this environment. If you do think the market's going to decline, there are bets you can make to actually take advantage of that. And that's perhaps the most confusing thing. To most beginners, you've been told, to just buy and hold, but sometimes this is not the best thing to do. There are certain environments that are better than others, and I don't think this is one of those environments where buying and hold the average stock is going to work out. But there is a way to take advantage of the difference in the environments. So let's first talk about what a stock is. A stock is really just a participation or an ownership in a company. So if you buy a stock in Apple or Tesla, you are a part owner of that company. And just to put it in proportional terms, let's say a company has 1,000 shares outstanding and you own 100 shares. You would effectively own 10% of that company. So whatever shares you own, that's your fractional percentage of that company. And really it's a bet that that company is going to do better over time and you're going to participate in that growth. 20 years ago, you could have bought Apple stock for $8, and now it's many multiples, many hundreds of multiples beyond that. So people have gotten astronomically wealthy picking the right stocks, and in situations like Tesla and Apple, becoming hugely successful just being in the right vehicle. A bond really is a debt. It's a promise by a borrower to pay you back, whether it be the United States Treasury. If you buy a Treasury bond note or a Treasury bill, which is like a very short-term 3-month obligation, that's an obligation where the government pays you back a certain amount for you putting your money in that debt instrument. So really a bond should be really thought of as a debt instrument, whether it's a corporate bond or a government bond. It's a promise to pay back the investor a certain amount of money plus their original principal. A mutual fund is where you pool your money and it's managed actively by a money manager. And typically you pay big fees for that. And then there are certain restricted hours. And so for, right now, the new generation of mutual funds are called exchange traded funds. These are very active. They're available. They're priced every minute of the day. They've got a lot of liquidity. And you could basically buy any kind of sector ETF. So if you think consumer durables are going up, you can buy that. If you think the retail sector's going down, you could sell the XRT. If you think energy is going up, you could buy the XLE. If you think financials are going up, you could buy the XLF. If you think the NASDAQ is just, going straight up, you can buy the triple Q. So these are very active, a lot of liquidity, and has a lot of advantages for today's investors, and really, are catered to investments. If you think, we've got an inflation in cycle, you could buy a commodities-oriented ETF. So you can position yourself in any one of these sectors, or just a general ETF that takes advantage of the S&P 500, which to me is the most advisable. If you really don't know what to do, especially if you're young, and this is what I had mentioned to my son the other day, just start socking your money away in an S&P fund. Historically, over time, that has beaten everything, beaten money managers, beaten hedge fund managers. It's really the way to go. One that I recommend, I'm not paid to endorse that, is the Vanguard S&P 500. The ticker symbol is V like Victor, F like Frank, I, A like Apple, and X like X-ray. So I think it's VFIAX, but it's the Vanguard S&P 500. And just start socking money away every month. Doesn't matter what the market's doing. Actually, if the market's going down, what that's allowing you to do is average down. And then whether it be 6 months from now or 2 years from now, the market will turn around. And if you just actively sock money away, you will, take advantage of the power of compounding and wake up, 5 or 10 years from now with a nice pot of money. So for beginners, that's the way to go. Just put it in an S&P 500 fund. And there are actually ETFs that are designed to take advantage of a falling market. So I've been advising our members that I think that the NASDAQ and the S&P are going to go lower for a host of different reasons, technical and fundamental. And you don't have to wait and watch your assets crash or wait for a buying opportunity a year from now. You can actually take advantage of a falling market. So 2 ETFs that take advantage of falling markets is the SQQQ. That's actually the inverse of the QQQ. And the way it works is that the QQQ is an ETF that tracks the NASDAQ. So if you think the NASDAQ's going down, you can buy the SQQQ, which actually is a triple inverse. So that means if NASDAQ goes down 2% one day, the SQQQ will go up 6%. So it's an inverse relationship. Most people feel more comfortable being long. So if you actually want to take advantage of a falling market, you go long or buy the SQQQ. The same thing for the S&P 500. The S&P 500 ETF is the SPY, but I think the SPY is going to go down considerably from here. So the way to take advantage of that falling price is to buy the SPXU. Now, that's also a triple inverse, which again takes advantage of falling prices in the S&P. And those are more trading vehicles. So if you make, nice 10, 15% pops in that, get out because they're repriced in certain ways and they're really meant to be trading vehicles. So it's a little bit more short term, but again, it's just another way for you to take advantage of a very difficult environment. This is not a one size fits all, and you've got to be able to adapt to what's going on. So if you're confused about investing, be sure to keep an eye out for our next video, and they will create a guide on what to do for beginners going forward. So hope to see you next time. Thanks for your support, and we'll see you again.